Loblaws has been in the news a lot this year over high food prices and record profits. Are those profits making their way back to shareholders? Fasten your seatbelts, folks. This is going to be a good one. Loblaws is without a doubt Canada's largest retail grocery chain. They exist from coast to coast under many names that include, well, of course, Loblaws, No Frills, Real Canadian Superstore, TNT Market, and Shoppers Drug Mart. In fact, they have more than 2,400 stores in Canada. They do have competition in other big chains like Metro and Empire. That's the one that owns Sobeys. You could even say that stores like Dollarama and Alimentation Couche-Tard are also vying for some of their market share. Metro and Empire remain their major competitors, and we will look at some of their data in this deep dive. Kind of makes sense, as it does give us a great comparison tool when we are assessing just how well Loblaws is doing. One thing that does have to be in the back of our mind regarding Loblaws, and, well, the sector in general, is the government's push to lower food prices. This has potential impacts on profitability, as Loblaws could be put into a position where they need to increase efficiencies in their supply chains to get prices down. There was also a small soft boycott of Loblaws in Q2, but any impact that has had is not going to show up until their next quarterly results. How much of an impact all of this has had is still yet to be seen. The data we will be using for this deep dive is, of course, from Loblaw's Q1 financial report. They did have a strong quarter overall, and we will look at a few of the highlights of that report. They experienced revenue growth of 4.5% compared to Q1 in 2023. This growth was primarily driven by an increase in their overall retail segment sales. Physical retail sales were up by 3.4%, drug retail was up by 4.0%, and pharmacy sales were up by a nice looking 7.3%. However, if you take a look at their e-commerce, they did even better, because those e-commerce sales, they were up by 16.1%, as more and more people are shopping online. They also saw a big increase in their financial services by 10.7%. Those higher rates have boosted their credit card receivables big time. Those sure are some great accomplishments for them, but we need to get into the numerical meat and potatoes of it all. That means it is once again time to call on that hero who solved for X faster than Lassie got Timmy out of the well. The one and only Mr. Math. We will kick off this deep dive with a little bit of surface data. Their current value at the time of recording was $166.91. Their market cap comes in at $51.08 billion, and this is a crazy beta of 0.15, so there's not a lot of volatility with this one. Their earnings per share come in at 6.69, and they have a price to earnings ratio of 24.89. Now, the average amongst those peers is at 18.0. Those peers include Metro at 18.69 and Empire at 12.13. Looking at these PE ratios, it does appear that Loblaws may be a wee bit overvalued compared to their peers. Their price to book ratio, that comes in at 4.6. The average amongst those same peers, 3.4. Looking at their return on equity, that comes in at 19.53, and they have return on assets of 16.04. These numbers are absolutely solid, and pretty much the only little blip on the radar is that potential for Loblaws to be overvalued. Let's peel back another layer and take a look at their cash flow data. They have revenue of $65.85 billion, and their earnings on that comes in at $2.19 billion. Now, those earnings are projected to actually fall by 0.4% per year. This is actually not as bad as it looks, as they are still looking at north of $2 billion in earnings. Their profit margin, that comes in at 3.5%. They have a free cash flow of $3.45 billion and an operating cash flow of $5.60 billion. I really do like seeing a healthy cash flow, and Loblaws has that big time. Let's take a look at their fair value. Now, their current value, as I mentioned before, $166.91. If we use a discounted cash flow model, we do get a fair value of $129.81. That puts them overvalued at 27.9%. We were expecting them to be overvalued, and the PE ratios, well, they did not lie. In case you are curious, both Metro and Empire come in as undervalued. Metro is undervalued by 11.2%, and Empire is undervalued by 4.2%. Now, that 1-year projection for Loblaws, that's coming in at $161.90. So that's only a 2.0% increase in their share value over the next year. That is not a lot, but it is better than Metro, who is projected to fall in value by 2.9%. Empire, on the other hand, is the big winner here, as they are projected to grow by 9.5% in the next year. We should paddle down a little deeper and take a gander at their dividend and returns data. They have a dividend yield of 1.236%. It is a quarterly dividend of 51.3 cents per share. Payout ratio on that, 26.63%. And their 5-year average dividend increase, that's coming in at 12.57%. Looking at their returns, on their 3-year, they have a return on investment of 107.99%. Total return after we add in the dividends, 114.09%. Holy banana bread, that's not too shabby. If we look at that 3-year for our friends, Metro's coming in at 34.62% on their total return, and Empire is negative 5.67% total return for the 3-year period. Loblaws has absolutely dominated on the 3-year. Let's take a look at that 1 year. On the 1 year, Loblaws comes in with a return on investment of 39.41%. Sprinkle in some dividends, we get a total return of 40.95%. If we look at Metro, their total return, 10.22%. Empire, negative 1.32%. Once again, Loblaws absolutely still dominating on the 1 year. How about that year to date? Well, Loblaws has a return on investment of 30.69%. Add the dividends, we get a total return of 31.10%. Metro's year-to-date total return comes in at 18.18%. And Empire, well, it is positive. At least we can give them that, 1.94%. Clearly, regarding returns, Loblaws is uncontested. These are some very nice numbers. Well, at least for Loblaws. Okay, it is time to pull back the last layer and take a look at their debt situation. Loblaws has a total debt of $8.70 billion. Their total equity comes in at $11.30 billion. That's a debt-to-equity ratio of 77%. Metro has a debt-to-equity ratio of 40.5%, and Empire comes in at 20%. So clearly, Loblaws has almost twice as much debt as Metro and 3 times as much as Empire. 5 years ago, Loblaws had a debt-to-equity ratio of 65.2%, so they have been moving the debt in the wrong direction. Now, they do have cash and cash equivalents sitting there as well. That's coming in at $1.61 billion. Let's take a look at the short term. On the short term, they have assets of $12.98 billion and liabilities of $10.11 billion. I am okay with that. On the long term, they have assets of $25.26 billion and liabilities of $16.83 billion. Once again, that's not too bad. Of course, I do love it when the short-term assets beats that long-term liabilities. We don't get that here. I am not a fan of their debt situation, but it is not that bad at the same time. Their debt itself is well covered by their operating cash flow, and the servicing of that debt is also well covered by their EBIT. You remember them, earnings before interest and taxes? The biggest concern I have is that they are moving the debt in the wrong direction. However, sometimes debt can be a good thing, and this may be what we are experiencing here. Loblaw's decision to increase their debt is a strategic move aimed at fueling growth, modernization, and adaptation to the changing market conditions. These investments are intended to position Loblaws for long-term success and competitiveness in their retail environment. To me, that certainly does come across as good debt. I think we have enough information to ask that big question. What is my final verdict? We really have 2 key questions we need to answer. First, are shareholders benefiting from Loblaw's record profits? Second, is Loblaws the better choice between them, Metro, and Empire? Let's look at that second question first. Loblaws has clearly rang up the larger total returns between the 3 companies, and that may not be a guarantee that they will continue to do so, but it sure does stack the cards in their favor. You can argue that Loblaws is overvalued compared to the other 2, which are undervalued. However, Remember the debt, and keep in mind that Loblaws is using debt to power expansion and modernization of their stores, and that should help them better compete in a game they're already winning. It does boil down to Loblaws simply being the better choice for long-term investment between the three. Let's look at if these record profits aren't coming back to the shareholders. A year-to-date total return north of 30% is a huge yes as far as I am concerned. They did also increase their dividend for this year by 6.7 cents, which is not too shabby. I like this stock, and I do think it is a solid total return blue chip circle the wagon foundation stock. It looks good short, mid, and long term. The passive income investors may not like this one, as the dividends are not huge and most of their total return is coming from growth. It is not a must-have income stock by any definition of the words. If you are interested in Loblaws or the other two, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on EQ Bank. Thank you for watching, and I will see you in the next video.